All right, a full of surprises policy, contrary to what we were expecting, a 50 basis point rate cut, coupled with a 100 basis point CRR cut, although stance has been changed to neutral from accommodative. You've seen CPI forecast also revised lower to 3.7%. To understand, what the governor's tone indicated, it does seem to be a very, pro-growth kind of approach that the RBI has taken. To understand the future trajectory, I'm joined by Rajani Sinha, Chief Economist at CareEdge Ratings. Rajani, lovely to have you here, full of surprises. Stick to the script kind of a policy. 50 basis point on the repo front plus CRR cut of 100 basis points. Your initial thoughts?
Yes, absolutely. Like you said, the policy support, the extent of policy support has come as a surprise. We were expecting around 25 basis point rate cut, though overall for the year we had factored in 50 basis point rate cut, but we were expecting that probably the central bank would wait for a couple of more months, see the scenario, and then go with another 25 basis point rate cut. But I think what has given comfort to the central bank is on inflation front. The last inflation point coming at 3.2%, and in fact, in the last 3 months, consecutive months, it has been below 4%. Moreover, aspects like expectation of above normal monsoon this year, given that global commodity prices are expected to remain benign, specifically global crude oil prices, I think all that has given the confidence to the central
Hmm.
bank to go ahead and cut the rate, front load the rate cuts and cut by 50 basis point at one go. And also the important thing to note is that the governor highlighted the important aspect that the global situation still remains quite uncertain. So if you see, compared to the
Hmm.
concerns that we had around April, May, regarding reciprocal tariff and overall global trade policy uncertainty, that has kind of, mellowed down in the last few weeks. Nevertheless, there is still a lot of uncertainties, and hence the RBI governor has highlighted that given the global uncertainties, they would continue to remain cautious and focus on supporting growth.
Point taken. We'll talk about the future trajectory as well, but let me also get on board our next guest, another gentleman who's joining in, Sunil Subramaniam, market expert. Sunil, was this the push that markets were waiting for? Because we have fired up and how, especially on the Nifty Bank Index. We made a fresh high. It's almost a 700 point move, a 1.5% move on the Nifty Bank Index. We made a fresh 52-week high of 56,457. We were consolidating, and now look at the way the markets have also taken off, given the double bonanza that we have got in terms of CRR cut and a 50 basis point rate cut. Are we ready to, make a dash at, the previous highs on the Nifty as well? Because after being ranged, this is when we get out of this range of 24,500 to 25,100.
Well, yes. First of all, you said as market expecting, absolutely, market was not expecting. And I think that's the biggest thing, that market always reacts to surprises, negative or positive. And this has been probably the most huge positive surprise that you could have expected. The second, I think that while I share the thoughts of the previous speaker in terms of the economics of the decision, what I liked was the clarity of thought that along with the rate cut, he's brought in the change in stance. Why I'll tell you this is very important? Because if the stance had continued to be accommodative, it indicates a worry that he's doing everything he can, but there's still worry. But by changing the stance, he has been very clear that he's front loading, he's taking a risk. There's a leap of faith by the RBI governor, because not only this, the 100 basis point CRR cut. So clearly he's focused on what? So if you see, go back to this, the fiscal policy and monetary policy are today in coordination. They gave 100,000 crores of giveaway to the middle class, and now he's making sure that the banks pass on the rate cut through the CRR cut. 2.5 lakh crores of money released for the banks, right? Now, if they
Yeah.
don't pass it on, it goes to their profits. But I think that fiscal and this going hand in hand is that he's taking the leap of faith. And I think that this will be the thing which will take the economy out from its where it's stuck at the 6.5 level, and in an uncertain time help us push towards 7. While the RBI has not revised the growth projection yet, it's still at 6.5, but this will cascade into a much higher growth rates once we have a BTA and everything signed. So I think that I would compliment the RBI governor. It's a 10 on 10 policy that you take a risk, right? In a positive way before anybody expects it, because that will now create a multiplier effect in the economy. Hats off to the RBI governor. I think I've been a bull on banking for quite some time on your show, you're aware, right? And I think this is the payback moment for all the earlier thought processes.
All right, a 10 on 10 policy. Of course, a lot of money gets mobilized and gets lent out, right? So that will help out banks as well. I will talk about sectors, etc. But let me come back to Rajani. Rajani, does this change of stance mean that we have already seen the end of the rate cut cycle, or would you say that going forward in the rest of the financial year, one more rate cut could come by, given the situation and how it unfolds? Your thoughts, whether we are looking at 5.5 as a terminal rate, or it could be a little lower from here?
The way I look at it is that the change of stance basically means that going forward, the decision will actually be data dependent. And the most crucial data to watch here would be what happens on the growth front. Because specifically on the global front, there are too many uncertainties, and it's very difficult to say how it's going to play out in the next few months. Given the progress that has happened on the reciprocal tariff front in terms of, China, US also, the trade talks progressing relatively towards, positive side. Given that US has postponed the reciprocal tariff for 3 months, things seems to be on a little better footing, but you never know. So I think that's why it's very important to be cautious, because if things deteriorate on the global front, India would get adversely impacted, though India's trade exposure as such is much lower than many of its Asian peers. Hence, the impact of the global developments would be relatively less. Nevertheless, we are all too interconnected now. So India would also feel any severe global crunch. India would also feel the impact. Hence, it's wiser to be cautious. And in case growth falters, RBI is expecting GDP growth of around 6.5% for FY26. Our estimate is little lower at around 6.2, 6.3%. But if growth falters and gets worse than the 6.2, 6.5% range, we could see another rate cut happening during the year. So that would really depend on, how the growth indicators pan out going forward. But for the time being, from the indication that the central bank has given by changing the stance, it means that we should not expect any more rate cuts this year unless the growth turns out to be much worse than what is being anticipated currently.
Okay, that's the view. Of course, it will be data driven, and how growth pans out, that would be the main decider as to whether or not we'll see more rate cuts going forward. But Sunil, with increased lending and so much money mobilized for lending, what happens to bank margins? That's my first question. And secondly, we've seen earnings trickle in from banks, and there were one-offs, of course, in terms of higher MFI exposure. Banks got impacted, but otherwise bank performance has been fairly good in the fourth quarter. So how would you play the rate cutting cycle, via the private banks or the public sector banks?
So my preference would still be the private banks, and for the reason being that you talked about the net interest margin pressures, right? Now, obviously, banks would go all out in a competing scenario to reduce rates on lending products to boost the volumes, right? So you would then say, oh, then margins will get affected. But there are two things here, right? There's 2.6 lakh crore of CRR cut, which is going to aid the profitability of banks. So your NIM margin pressure, whatever you face on the new loans, would get compensated by 2.5 lakh crore of additional profits, because you're not placing that much money at 0% with the Reserve Bank, right? That's number one. Second aspect is that if you look at it, the incremental loans to existing loan book share is very, very small. So in the existing loan book, private banks have got auto loans and personal loans, which are fixed rate loans. So there's no impact on the existing lending book on in terms of the interest rates. It's only the fresh loans getting added, which will be at lower rates, and they don't need to reduce the deposit rates so much. But if you looked at it, already the banks have cut deposit rates in the previous quarter itself, and that's why if you see their deposits were actually surplus. So you see the end of March numbers, bank deposit growth rate was far higher than the lending growth rate, and banks were placing their surplus with mutual funds in liquid schemes and overnight schemes. So banks are flush with money. The governor also mentioned about not only the banks being flush with money because 9.5 lakh crores of liquidity is already provided, but he also mentioned about the quality of the banks. He said the banks are in very good position. So to that extent, right, the NIM pressure on new loans is going to be there, will be compensated by the CRR cut and the fact that existing loan rates may not come down so fast. So I think overall the volume growth will more than make up in a EPS number because it's priced into quantity. So I don't think that you will expect to see EPSs continue to grow. Though new loans, there could be margins being less, but I think that's worth it because ultimately, if you want to kickstart the economy, and that's where, the way the RBI governor's approach, if I may make one more point, is that he is talking about strengthening what India is strong at, which is domestic demand. So he's, instead of looking at it as a defense against the international tariff scenario, he's saying, let's go and play our domestic the strongest we can. So if domestic demand is going to grow even stronger, that's the best counter tariff related uncertainty on the export side. So I think that the doors are very clear for a massive rate cut on lending products at the personal loans, auto loans, real estate loans side. And hopefully with the 1 crore of giveaway in the budget for the middle class, we should see a strong revival of urban demand. And since that's the case, it's the private sector banks which will lead that because they'll be very fast to act, turnaround will be very fast, and public sector banks will gain over a period of time when industrial lending picks up. But the initial phase of it, private sector banks are going to walk away with the bulk of the new loan sourcing that's going to happen.
But what about NBFCs? NBFC sector will also directly benefit, right, because of lower, cost of funds and, potentially improved credit demand. So within the NBFC space, Sunil, would you look at the larger names?
Yeah, absolutely. Why I'm saying this is they need to have bargaining power because the CRR cut is only for the banks. So how much NBFCs borrow from the private sector, they borrow from market, but they also borrow from banks. So to the extent that what extent banks pass on this lending to NBFCs versus directly lending to themselves, there's an issue. So I would weigh on the larger NBFCs because they have bargaining power. And so the larger NBFCs will be the better ones to bet in because ultimately they are dependent on bank lending as a part of their liability book to lend to that. But otherwise in turnaround time and the reach, the last mile reach, clearly the bigger NBFCs are way ahead of even the banks. So yes, I would place my bets on the larger NBFCs who are in the retail space.
Sure. Rajani, in terms of the CPI forecast, it's been reduced by 30 basis points to 3.7%. Were you working with a similar downward revision to inflation forecast, or were you expecting the governor to reduce it by, say, 50 basis points to 3.5%? Would that have been overly optimistic? And what are your own estimates when it comes to inflation for FY26?
So, see, on the inflation front, we were expecting around 4% or so. So, while if you see the situation has improved in the last few months, like I mentioned earlier, the CPI inflation in the last 3 consecutive months have come less than 4%. And the critical aspect is that food inflation has started moderating quite significantly. And that has probably given the comfort to the central bank to reduce the inflation forecast. And on top of that, the other important thing is that even the global commodity prices are likely to remain benign this year, given what's happening on the global growth scenario. If the global growth is expected to moderate and the demand is expected to moderate, we do not expect much pressure on the global commodity prices. And crude oil prices easing and overall commodity basket prices easing is a big comforting factor for India too. But why we had kept a little higher buffer of around 4% inflation is simply because it's very difficult to project on food price inflation. Right now, the projection is of above normal
Hmm.
monsoon, and hence the expectation that this moderation in
Hmm.
food prices that we have seen is likely to continue. But let's keep in mind, it's not just overall monsoon, but it's also the spatial distribution of the rainfall, the temporal distribution of rainfall, and
Hmm.
also increasingly what we are seeing in the last few years is any other kind of climate related disturbance which has been growing in the last few years. It could be unseasonal rainfall, it could be heat waves. We have seen this year monsoon starting before than was earlier expected. So these are some of the other aspects related to climate, because of which we need to be wary as to how food inflation will move going forward. But yes, this I'm just talking about being cautious, but
Hmm.
otherwise, the situation as it is right now, yes, there are no concerns on inflation front. It is likely to remain comfortable.
Hmm.
And I spoke about supply side factors. Even if you look at demand side factors, which is reflected in core inflation, though
Hmm.
core inflation has inched up a little in the last few months, but it's still close to 4%. We don't see it rising because we don't see the growth momentum being so strong as to put a lot of upward pressure on demand side inflation. So, in a nutshell, yes, there is not too much concern on
Hmm.
inflation front.
Okay, yeah, no, not too much concerned on inflation front, but let's also talk about the bond market, so to say. I think the yields are fairly quiet. I mean, there's not been a big move in the bond market, but when it comes to the yields, Indian yields, we've seen a 75 basis point correction in yields in the last odd months or so. Do you now, with this 50 basis point rate cut coming in, do you expect yields to come down to 6%, sub 6% even, or would you expect it to remain at where it is right now?
So, market
Rajni.
had actually kind of, already factored in rate cuts, and 25 basis point was expected in this policy. And market was also factoring in another 25 basis point later during the year. They were not expecting 50 basis point at one go, but yes, the expectation was of another 50 basis point during the year. So yields had already reacted to that, and we had seen yields going down, like you mentioned, in the last month or so. Now, important point to note is that the RBI has changed its stance to neutral, which implies that going forward, most probably there's not going to be any further rate cut. Yes, like I mentioned, unless the growth comes
Hmm.
out much lower than expectations and we see the growth faltering, then there could be a further rate cut. But otherwise, we should not expect another rate cut. So I guess that's why there's not much movement in yields post the policy. I do not expect the
Hmm.
yields to go below 6%, but yes, we can see a little lower than these levels
Hmm.
during the year. So I would say around 6 to 6.2% during the year is what we are expecting.
Okay, 6.2%. That's the expectation. But coming to you, Sunil, what changes when it comes to the FPI flows? Because the rate differential, the yield rate differential, has significantly narrowed, and of course,
Mm.
U.S. yields are going up for higher U.S. debt. That's
Mm.
another trigger for U.S. Bond yields going up. But for us,
Mm.
it's narrowed quite significantly. But given the fact, the kind of measures RBI has taken, to boost lending, to boost growth, etc., do you think that would, compel the FIIs to in fact take a relook at their portfolios and perhaps not pay so much attention to the narrowing gap, because nobody would want to miss on the India story, right? Because that's still the fastest growing emerging economy.
No, actually speaking, this narrowing gap, first of all, let me state that this is a big positive for FIs to come in. Okay. Now, let me address the last point that you raised first
Hmm.
before I speak about that. The narrowing gap is actually positive for FIs to come in, and let me explain why. Because the currency movement of two
Hmm.
countries is a function of the difference in the interest rates. Now, this narrowing gap means in the future, the depreciation pressure on the rupee will be much less, because now the fundamental reason for depreciation is the difference in interest rates, which is only 1.75 today. And as the previous speaker was saying, if there's even a 25 basis points cut in India's long-term yield, that differential comes down to 1.5, which means the rupee depreciation will be only, the long-term average rupee depreciation is 3%, against which is only 1.5. So an FII investing today in a scenario where he had already baked in a 3% in the normal course rupee depreciation, already has seen it come to 175. If it goes further down to 150, his any loss on account of rupee depreciation becomes that much less. So there's actually a fresh impetus to put more money into India now, because relative to other emerging economies, Indian economy's depreciation is going to be less. That's the point. So for me, the interest rate differential narrowing is a positive for FIs to come in. So that's one. Second, the reason why this will be a big positive for FIs, because 35% of the large cap index or the MSCI index is banks. And as I said, a 2.5 lakh crore savings to banks, because they're saving on 0% CRR, is a huge positive for banks. And if you have the lending also picking up, right, even passive funds allocation to India should step up because of the sheer weightage. So there would be a big flow into India passives from abroad. So to me, that banking sector is a big bellwether for an FI to take a call in India, other than IT, of course. So that's again another positive. The third is that this is giving the Indian economy domestic resilience, because this rate cut, as the RBI governor mentioned, he's supporting this 1D, the domestic demand. And if that picks up, that's the best support you can have against tariff uncertainties. So I think that their whole look about the Indian economy, and for them, India is a stock. They will reprice this stock very quickly. And I think this, along with any positive news on the BTA coming forward, right, will be a huge positive, and it should open the doors for a lot of even short-term FIIs now look positively at India. So I expect that that will come in and itself help the currency, because the flows itself will come and give a support to the Indian currency. So overall, I think this is a big positive for FII flows, which I hopefully over the next few weeks you should see a huge inflows coming in.
Okay, expect huge inflows over the next few months. But talking about the bond market as well, Rajani, the outflows from the bond market by FPIs, from government securities were the highest so far in the quarter since the inclusion of Indian bonds. But do you expect some rebalancing there and inflows to come back into the bond market here on?
So yes, you are right. We have seen outflows from the bond market, and that has also got to do with what is happening to the US yields, which have been rising very sharply. Now, what to expect going forward? Yes, we could see some inflows coming back into the debt market. But as far as the bond inclusion is concerned and inflows because of that, we do not expect very significant inflows this year. We did see a lot of inflows coming into the debt market last year because of the bond inclusion. However, this year, because of that, the expectation is not of any huge amount. But nevertheless, overall, we could see inflows improving to some extent. Overall, I think for as far as FII inflows are concerned, we need to be cautious on that front. It could be volatile going forward. The important aspect to note here is that even though I'm saying it will be volatile, eventually market may look at the fact that overall in the global scenario, India would be one of the fastest growing economies in 2025. Even if we go with the IMF's projection, which is lower at 6.2% as against RBI's projection of 6.5%, we are still talking about a large economy recording a good growth. So in that sense, they could be some comfort for FII inflows. And here I'm talking about equity too. And we could see some improvement in FII inflows going forward.
Okay, we could see some improvement in FII flows going forward in the bond market as well. But what happened to call rates from here on, Rajni? When we had the repo rate at 6%, the call rates stood at 5.75 or something like that. But now with repo at 5.5%, what happens to call rates here on? How much more lower can they go from here?
So, if you see in the last 2 months, in fact, the call rate had been hovering around 25 basis point lower than the repo rate. So, there was already effective easing by 25 basis point that had happened even before the repo rate cut. So, and now RBI has announced a 50 basis point rate cut, and they have injected huge amount of liquidity with the 100 basis point cut in CRR, which implies that liquidity is going to remain surplus. It's going to remain abundant in the market, which implies that money market rate will remain quite soft, and we could see call rate hovering below the policy rate going forward also, which is what the central bank actually has been attempting to do. The idea is to ensure that there is good transmission of policy rate cut, and to
Right,
ensure that the money market rates also kind of
right.
factor in the policy rate cut and surplus liquidity that is there in the market. So we could expect the money market rate to remain
Sure.
softer than the repo rate going forward.
Okay, that's the view then. With that, Rajani, would like to thank you for taking our time and joining in and sharing your thoughts with us. Always a pleasure, and look forward to interacting again sometime soon. Well, with that, let's also get on board Lata Venkatesh of CNBC TV 18 and understand her thoughts on the policy.